Zoom stock fell 88% from all-time highs, and to help you decide if this is a good buying opportunity, I'm gonna present to you 6 reasons I see to be bullish on the stock and 5 others to be bearish. I'll also calculate its valuation in order to find good prices to buy. Starting with the bull case. Zoom has a very scalable business model. As their existing customers need to contact other people, they bring new users to the platform without Zoom having to pay for it. It's also a subscription service, meaning they don't have to sell over and over again to the same customer. They have predictable revenues and low churn rate. Zoom's balance sheet is extremely healthy. They have about $1 billion in cash and cash equivalents and another $4 billion in short-term marketable securities. In terms of debt, they only have a small lease of $78 million. The only relevant liability is deferred revenue, which are payments they receive in advance from customers. As time goes on, this gets out of liabilities and into revenues, a regular accounting practice in their business, nothing to worry about. Unlike most companies that fell over 80% in this market crash, Zoom is profitable. In the last 9 months they did $208 million in profits and a little above $1 billion in operating cash flow. It's no secret that during 2020 and 2021, Zoom had an explosion in revenues as everybody had to work from home. However, even prior to that, Zoom has always managed to pull off incredible growth rates, 119% in 2018 and 100% in 2019. A lot of people think Zoom is just a simple video call app like many others, but they are actually doing a lot more than that. They currently provide a bunch of services that are categorized in 5 different groups. On Zoom One, besides the well-known virtual meetings, they also have features that complement the whole communication system of a company, things like team chat for co-workers to collaborate better and faster. Zoom Phone to make phone calls anywhere in the world. Events, where people can broadcast at large scale, host hybrid or virtual events. Whiteboard to create and do brainstorming. Email and calendar to send and receive messages, as well as calendar invitations. On Zoom Spaces, they enable companies to deploy intelligent hybrid workspaces, ranging from customizable workspace reservations to digital signage and scheduling displays. Zoom Contact Center helps businesses deliver prompt, accurate, and highly personalized customer experiences. On Zoom AI, they have IQ for Sales, a conversational intelligence platform for sales teams that provides actionable feedbacks, statistics, and insights on the sales funnel. They also have Zoom for Developers that allows developers to build Zoom apps and integrations. They are really strengthening their products portfolio for the enterprise market, building a full-stack solution for all kinds of communication, which I think is the right way to go here. Zoom achieved a sector standard status. It's the clear option when most people think about virtual meetings, and as they built such a large base of customers, the network effect I mentioned on their business model works perfectly. Moving on to my bearish arguments. Thinking long-term, I'm not sure if all these services they have are enough. Although Zoom has all these features I just mentioned, they are all focused on communication. And as other big tech companies are entering the space, Zoom might end up with a big disadvantage, which takes us to my next argument. There is a lot of competition in the space. It's not such a complex technology to develop. For personal use, there are dozens of free options out there, delivering a similar experience. And for business, you have some heavyweight competitors such as Google and Microsoft. The thing with these companies is that they already have a large customer base and a ton of great products that combined becomes almost indispensable for any company. Let me give a real example here. My startup pays a service to Google called Google Workspace, the old G Suite. We pay that to have a custom business email, and with that we also get other services such as cloud storage and Google Meet for business, so the thought of paying for a service like Zoom has never crossed our minds. This is the case for a lot of companies. Microsoft is kind of the same. A lot of business all over the world have their entire work process using Microsoft's products, and Teams is the obvious option for them. Another problem I see here is their price. Zoom is more expensive than Google Workspace and Microsoft Teams. Their paid plan starts at $149 per year, $12.42 per month. Microsoft Teams starts at $4 per month and Google Workspace at $6. I do think they have a few advantages over their competitors. They have all the features I mentioned on the bull case, while most competitors offer a more simple solution. And they offer a free plan for business, which I believe to be a great strategy to acquire customers. The problem with these advantages is that if they are in fact working, it's just a matter of time for their competitors to copy. There is nothing extremely complex here, especially for these tech giants. Zoom has the network effect to bring in customers, but it doesn't work to keep them. It's a pretty easy to use product that doesn't require a learning curve every time you use a different software. And it's not like you have a ton of valuable information there that you would lose if you had to change platforms. On the bullish arguments, we saw how Zoom has always had great growth year over year, but that seems to be changing in 2022. Last quarter revenues only grew 5% when compared to the same period last year. There was a 9% decline in Europe's revenues due to a stronger dollar and the Russia-Ukraine war. Revenues also dropped 3% in Asia due to the stronger dollar. Management's outlook for next quarter is that the enterprise business will grow in the low to mid-20s, while their online business will decline 8%. For the full fiscal year, they expect a total of 7% revenue growth. If you are thinking these revenue growth rates are bad, take a look at their earnings per share. It fell 85% from $1.11 to 16 cents. The problem is that while revenues kept slowing down, all expenses kept going up at a really fast rate. R&D increased 98%, which is fine by me. They have a lot of cash and need to reinvest in order to improve their products and create new ones. General administrative expenses increased 45%, which is bad, but manageable if Zoom starts pulling the brakes a little bit, as most tech companies are doing. The big problem for me is on sales and marketing, where they increased 46%. If they had to spend so much money to grow only 5%, it means their customer acquisition costs are way higher than used to be, a pretty bad sign that unlike the other expenses, are not totally under their control. These were my bullish and bearish arguments. Let's move on to the valuation now. In order to try to find the stock's fair value, I'll use my discounted cash flow. Consider assumptions for the next 5 years and 3 different scenarios, a bearish, a bullish and a more realistic one. For revenue growth, as we've seen earlier in the video, Zoom used to have huge increases every year, but the story has drastically changed, and they are now at single digits. We also saw that management is expecting something similar for next quarter, and analysts are also in line with these expectations, even for next year, which I personally don't have much reasons to believe otherwise. As I'm estimating an average for the next 5 years, and I think there is a good chance of them achieving at least mid-teens growth after 2024. I'll consider 8% on the worst, 11% on the base, and 13% on the best case scenario. On share change, they issued 1.7% of shares in 2020 after becoming public, 2.7% in 2021, and are basically flat now in 2022. Usually I would expect a profitable company with such a high cash balance and no debt to be decreasing the amount of shares over time. However, they are going through a rough patch, and my guess is they will probably stay close to flat in the next few years. With that said, I'm gonna consider 1% share issue in the worst case, 0% in the base, and 0.5% buyback on the best. Moving on to profit margin, Zoom became profitable in 2018 with a 2.4% net margin, followed by 3.7% in 2019. After the boom in revenues in 2020 and 2021, they raised margins to 25% and 27%. However, in 2022 it dropped back down to 16% due to the reasons I explained on my last bearish argument. Considering my thesis that things will remain bad for a year or so, but then get better, probably back to around 25%, I'll do 18%, 20% and 22%. For price to earnings, as Zoom was just starting to become profitable when they became public, their PE in the beginning of 2020 was 848. As their earnings skyrocketed after that, the PE came down to 73 approaching the end of 2021. With their earnings getting totally crushed in 2022 and inflation making every tech stock to tank, they are now at 32. Depending on when you are watching this video, their PE in most websites will be lower. The difference is because I already updated the numbers, I'm considering their trailing 12 months earnings ending in October 2022. Having said all that, considering that my expectation for growth is much lower than what Zoom used to do, and that their margins for the next few quarters will suck, their PE can't be so high, especially in the current stock market scenario. So, for the worst case, where I considered a 8% revenue growth, I'll go with a 13 PE, on the base 16, and 18 for the best. The last input is the expected returns per year. I use 15% for all scenarios. It gives me a good safety margin, And it's also a great performance when compared to the 10% market average. Great. Let's find out what a good buying price would be considering these scenarios. Keep in mind that this is not financial advice. On the worst case, the fair value for the stock is $34, meaning that it needs to drop another 55% from the current 75. I think this is a bit too bearish and it won't get there. For the base case scenario, the one I think it's the most likely to turn out, I got a fair value of $52, a 31% difference. This one I actually think there is a good probability to hit. The price on the best case scenario is $65. If this turns out to be true, then Zoom stock is not that far from fair value, a 13% difference.